The Federal Reserve raised interest rates by 0.75 points this year, the fifth boost of the year, in reaction to the 8.3% increase in inflation this year. But financial analyst and CEO of ARK Investment Cathie thinks the Fed might be committing grave errors in addressing inflation in this manner, noting that the organization might be missing some crucial information in the process. Welcome back to Everything Everyone. Tesla shares. The Fed has consistently declared its commitment to bringing down inflation rates to the lowest possible level. Although interest rate rises usually occur in increments of 25 basis points, the U.S. Central Bank recently announced a third consecutive 0.75-point rate boost, pushing interest rates to a range of 3 to 3.25%, the highest level since 2008. The Fed appears to be acting aggressively to lower the inflation rate, which is far higher than its 2% benchmark target. In response to the announcement, Wood said that although the Fed might view this as a successful strategy for containing inflation, the overall impact of this move might be extremely negative for the economy. What are the potential ramifications of the Federal Reserve's interest rate hike, and why did Wood make this statement? To stay informed about everything Tesla is doing by raising the interest rate, keep watching to discover out. But before we do, remember to like, subscribe, and turn on notifications. The central bank intends to discourage spending, which may lower inflation and the cost of goods and services. But this will also have unintended consequences, such as raising the maximum interest rate on home equity loans to 8% and possibly raising the monthly payments on newly purchased or variable rate mortgages. Despite Wood's belief that inflation is the primary cause of the economy's sharp decline, the financial expert also believes that companies are also likely to suffer the head of deflation, and this is a problem for investors to be worried about. No doubt inflation is hitting hard on the economy, but this time it's not as a result of the usual causative factors, but rather a product of major economic shocks that have never been seen before. Unlike in previous times, square factors like the crash in dollar value and oil prices caused inflation rates to spike. The case is quite different now, as issues like the pandemic, the supply chain problem, and the Russian-Ukraine war are all major contributors to inflation. This is not the first time Wood is revealing her concerns about deflation. When she previously spoke about the subject, she claimed that 50 of the S&P 500 is at risk of creative destruction, and most companies, especially automakers, are unprepared for the effects of deflation. Wood added that automakers could suffer bad deflation as well as commodity deflation if proper steps are not taken. In 2021, the stock investor warned that deflation, rather than inflation, will be the largest risk of financial markets and the economy in the coming years. According to Wood, the U.S. economy will grow less than many economists had predicted for the upcoming year. While the Fed's primary focus is on lowering inflation, there might be other aspects of the process that are missed. Downsizing may occur, and based on a number of indicators, deflation is progressively entering the system. One such indicator is the PAR index, which is employed. According to the report, wholesale used vehicle prices decreased by 3% in September from August, indicating that used car retail sales declined by 8% in September from August and were down 10% year over year. This is because the assumption about the residual value of cars is rather high, and most people bought cars in the hope that the used car price index would continue to rise, allowing them to sell these cars at a fairly high rate. However, this did not turn out to be the case, and it's possible that fewer people are purchasing used internal combustion engine vehicles. On the plus side, it might be a bad market for ICE cars, but it might be an opportunity for electric vehicles to take over since they're becoming easier to maintain, and there are new policies to promote these vehicles. This isn't because there is more production of these cars, rather, it's because they're getting harder to maintain. Furthermore, based on Wood's earlier analysis of inflation, innovation might be what saves EV manufacturers. After the creative destruction brought on by inflation, Wood predicted that automakers would struggle. He also mentioned that businesses that are managing their shares in the near term and investing less in innovation could find it challenging to meet the upcoming market challenge. Likewise, automakers that have pharmaceutical products that may go out of style will need to sell these goods at a loss or risk losing a lot of money. Cathie will force a change in the kinds of businesses that can prosper no matter what the state of the economy is, since she feels that only those with a competitive advantage in innovation can prosper in the face of the deflation she anticipates will inevitably curtail economic growth. Given how innovative Tesla has been, Tesla fans will probably exhale with relief at this point. Think you too think this? Please share your thoughts in the space provided below. If you haven't already, please subscribe and like the video. The Fed may assert that their approach is data sensitive, but most financial professionals, like as Cathie, are unlikely to buy into it. The Fed's statement, according to Paul Kroltz, portfolio manager at Kingsview Investment Management Chicago, was rather hawkish. He also said that the price increase suggests that the markets are volatile and that there is a greater likelihood of a recession in the upcoming year. According to Carson Group Omaha's chief market strategist Ryan Detrick, the Fed left the door open for many more rate hikes before the year is up. He called the 75 basis point hike fairly hawkish. The dots plots indicate that the number of rate hikes is higher than anticipated and that the Fed is prepared to cause significant harm to the economy and possibly the stock market in order to control the runaway inflation that has been observed this year. Detroit claims that the economy is rapidly going down and that the Fed's forecasts for it are very low. He went on to say that the Fed's interest rate policy might push the dollar higher, which would put more pressure on stocks. Musique. However, Federal Reserve Chairman Jerome Powell stated that the Fed is adamant about maintaining its position until it is certain that inflation rates are declining. If there is one thing you know for sure, it is that this committee is committed to reaching a meaningfully restrictive stance on policy and will not budge until we are certain that inflation is declining. In other words, the Fed is not about to give up on its quest for power anytime soon. Additionally, a number of Federal Reserve officials have stated that before any talks about loosening the policy can begin, they must witness several months of inflation that are heading toward 2%. While the Federal Reserve's current target range for its benchmark interest rate is 3 to 3.25%, it is still working toward a goal of quickly raising its benchmark interest rate to about 4.5%. Several officials had also stated that it will take a lot to push him off this path, and the Fed is prepared to go higher if the elevated inflation rates fail to show signs of easing after this. San Francisco Federal Reserve President Mary Daly discussed this in a recent interview with Bloomberg News. She stated that more policy adjustments will be needed to restrain the economy sufficiently. The U.S. Central Bank may be headed for a fourth consecutive 75 basis point rate increase in the future. The consequences of this move by the Fed may not be immediately apparent, but Cathie World believes that they will be eventually, even though this may affect not only the United States but other countries as well. What do you think of the comments? Do you think the Fed is making a mistake by raising interest rates to combat the rising inflation? Let us know below. Governor Christopher Waller confirmed this. He stated that until we see any signs of inflation beginning to moderate, we don't know how we pause. There is a lot of optimism that inflation is gradually easing.